Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Choice Hotel stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 5.7 billion market cap. They're trading at $118 a share, and they have 48 million shares outstanding. Choice Hotels is one of the largest hotel chains in the world, owning several hotel brands ranging from upscale to economy. It franchises nearly 7,500 locations, representing 630,000 rooms across 46 countries. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. They're the opposite of the other lodging companies. Highest in 2021, over 300 million, cut in half in the trailing 12 months to 154 million. Their dividend yield is 1%, so they pay out 55 million in dividend payments. They could afford the dividend. Net income is a profit or loss on the income statement. It's revenue minus expenses. That's pretty steady, 300 million to 237 million. Revenue is sales for the company. That's up 50% from 1 billion to 1.5 billion. Their revenue per share is $32. To calculate price of sales, it's stock price over revenue per share. So it's a little under a 4, maybe a 3.8. We estimated 4 years of future free cash flows. We also estimated a terminal value, it's all cash flows. Past year 4, that's 6.7 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $6 billion. We divide that by 48 million shares. And we get a calculated stock price of 124. They're trading at 118, so they're trading at a 5% discount. It's a buy according to the model. There are 12 companies in the same industry as Choice, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a good amount of CapEx, 128 million, a little more than the average. Look at that debt to equity ratio, 268. For every dollar of equity, they have $268 of debt. Well, at least it's not negative like Marriott and Hilton. They pay a 1% dividend, higher than the median average. Free cash flow of 154 million. Seems pretty low. Market cap 5.7 billion, a little lower than Wyndham, so they should be in 6th place. A really high price to book. They're trading at nearly 900 times book value. Their PE is a little better than the median average. Price to free cash flow, the worst on this list. They're trading at 37 times free cash flow, and they're trading at 3.7 times revenue. That means their market cap is 3.7 times their revenue. But their 5-year annual revenue growth rate isn't too bad at 8%, higher than the median average. If you put $10,000 into this company 10 years ago, you'd have $30,000 today. That's an 11% annual return, a 200% total return. Let's look at their first quarter earnings results. In their pipeline, over 115,000 rooms. That's a 10% growth quarter over quarter. Their RevPAR domestically is up 30%. Royalties up 70 basis points, or 0.7%. And RevPAR is up 8% compared to the first quarter of 2019, which doesn't sound too high. 8% is almost our inflation a couple of years ago, and that's over 4 years. Revenue 203 million for the quarter, up 16%. Adjusted EBITDA up 17%. And they returned 226 million to shareholders from dividends and stock buybacks. They bought back 1.5 million shares. Here's the outlook for 2024. Adjusted EBITDA 590 million. RevPAR flat to up 2%. They should have their record adjusted EBITDA this year if they hit the 590 million. 2023 was their highest at 541 million, which was a 13% growth from 2022. And 2022 was 19% growth from 2021. And 2021 was 67% growth from 2020. And we know 2020 was a decline year. Net income 31 million, adjusted net income 64 million. Diluted EPS 62 cents, adjusted diluted EPS $1.28. You can make any number positive or better, just adjust it. My average test score was 80%, but if you take away only 3 tests, it jumps way up to 90%. So my adjusted test score is 90%. Sounds a lot better than 80%, right? Here's our net income since 2017. Its highest was 2022, 332 million. 2023 actually went down. That's interesting. I thought it would go up. But both 2022 and 2023 were higher than 2019. So it looks like Choice may be the best choice. And they had the highest adjusted EBITDA in 2023, $540 million, even higher than 2022, even though net income was worse in 2023. It's because of all these adjustments. Net income for 2024 should be $270 million, adjusted EBITDA $590 million. Let's look at the stock on Simply Wall Street. Its last price $115, 5.5 billion market cap, down 2.5% in the past week, down 1% in the past year. Let's see what they say about the company. Choice operates as a hotel franchisor in the US and around the world. It operates through hotel franchising and management, also corporate and other. Their properties include the Comfort Inn, Comfort Suites, Quality, Clarion, Sleep Inn, Econo Lodge, Mainstay Suites, Woodspring Suites, Radisson, Park Plaza, Radisson Inn, Park Inn, and a bunch of others. Founded in 1939, headquartered in North Bethesda, Maryland. Here's the stock price since '98. It looks like its low point was in 2000. It fell to under $4. Look how high it got in 2006 to 58. If you bought it in 2006 at 58, by March 2020 it would have been below your purchase price. It fell to below 55. It fell to actually 54. And then it tripled by January 2022 to 150. It's come down a little since then. It's trading around 120. Simply Wall Street's valuation is 122. They say they're 5% undervalued. 12 analysts priced this stock at 126. The revenue forecast for 2024 is 1.6 billion, 2025 also 1.6 billion, 2026 1.7 billion. And the free cash flow forecast is under 400 million for 24, also under 400 million for 25. Their revenue back in 2013 was 700 million. It peaked in 2020 at 1.1 billion. Then it came down to 370 million by the end of 2020. It came up, then came back down, which is kind of odd. Now it's at 740 million, a lot lower than 2019 levels. Maybe Choice is not the best choice for a stock pick. This red line is their debt. They had 900 million of debt in 2013. They reached their highest level, 1.7 billion currently. And they did have negative equity. It got up to 400 million in 2022, but now it's only 7 million. So that's why their debt to equity ratio is 25,000%. And this green line is their cash. They keep almost no cash on their balance sheet. The CEO's salary went from 800,000 to 1.1 million. Total compensation 6 million, tenure as CEO 8 years. Only one insider activity in the past year, a sell for 145,000 shares. 64% of the company is owned by institutions and 36% by insiders. The founder of the company, Stuart Bainum, was a plumber. Then he opened up a hotel chain. Then he franchised it. The Bainums are the biggest shareholders. Stuart Bainum Sr. lived into his 90s, but died 10 years ago. This is his son, Stuart Jr. Barbara is Stuart's sister. The founder's daughter, Roberta, owns 4.7%. The British company Fundsmith owns 1.6%. Their employee count is pretty steady, around 1,800. And the ticker trades on the New York Stock Exchange and Deutsche Börse. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.